Over the last few weeks, we have seen extraordinary moves in precious metals. Gold punched through $4,000, hit resistance around 4,380, then posted its sharpest one-day fall in over a decade, while silver dropped 7.5% in a session. And yet both metals remained strongly higher on the year. Some call it a healthy consolidation. Others think it signals something deeper. Under the surface, there's a very physical story. Roughly 29 million ounces of silver have just left COMEX warehouses as London tightens, reminding us that whatever the charts say, this is still about real metal moving through a supply chain. We've looked at the macro. We've talked about ratios, policy moves, capital flows. But at the end of the day, gold and silver aren't theories. They sit in vaults. They are shipped. They are bought and sold by real people making very real decisions about their wealth. So today, we're stepping into the real world and asking what's actually happening on the ground. How are investors behaving amid record prices and big swings? Are we seeing the first signs of exhaustion or the first wave of something much bigger? I decided it was about time we heard from someone who can give us even more insight as to what's really going on. Dave, thank you for coming on and talking to us. As I've just been saying to the viewers, I talk to them all the time about what's going on and the numbers that we're seeing and the stories that we're reading. But this is a very real situation going on with two very real metals, gold and silver. And as someone who is living this day to day, who's talking to clients and all aspects of the supply chain, it's well worth taking some time to talk to you about what you're seeing, the conversations you're having, and what that's leading you to think about what's been going on and what's coming up in the future. So can you maybe give us a bit of a background about what your last few weeks have been like since the most recent surge and the pullback as well? That would be great.
Sure. As the Chinese say, may you live in interesting times, and these are definitely interesting times. The last couple of months have been super busy for us here at GoldCore. It's driven primarily by what we call an uptick, the strong rally in the gold price, but that's had kind of knock-on impacts into all metals markets. I mean, at the end of the day, we're talking about a physical product, and that physical product ultimately, it has to get into the hands of the buyers, but it goes through a very long supply chain once it comes from the mine through to the refinery, through to the minting process, through to the wholesalers. And what we've seen over the last couple of months with such high demand, and also everything else that's going on in the world. And we can't forget that this rally over the last couple of years, as I've been heard say many times, has been driven by central bank buying. Now, central banks, when they're buying precious metals, when they're buying gold in particularly, it's much larger format gold bars that they're buying. It's the 400-ounce gold bars. It's the kilo bars that are settled on the exchanges. So it's very much driven by large format gold bars from the central bank point of view. But as we've seen more and more of that buying, it's having a knock-on effect down through the supply chain and also spills over into the other metals as well.
So when people are crying about, not crying, but they're sort of shouting about these shortages that we're seeing, it's not a case that there is no metal out there. It's just the fact that there is a product that ends up producing multiple products, as it were, into different types. And that is where it sounds like, from what you and I have been discussing beforehand, there's a tightening there as that feeds through. Is that fair?
Yeah, I mean, you covered this excellently in a recent video of yours, and you were talking about the challenges in the market with respect to, say, backwardation, and what that meant is there's a shortage of product, and that's specific products. There's a shortage of those products in specific locations. So whether particularly we're seeing a lot of stress in the moment in the silver market. And in 1,000-ounce bars, there's a shortage of 1,000-ounce bars. There isn't a shortage of silver. I stood in a vault in Switzerland a week before last, and in that one vault, and there was 3 vaults in this facility, in that one vault alone, there was $700 million worth of silver stacked up in 1,000-ounce bars on pallets. And as I said, there was 3 of those vaults at that facility. There isn't a shortage of silver. There's a shortage of silver in the right place, and there is a shortage of silver being released and available for sale at current prices. So that's one of the reasons that we're seeing the uptick in prices. There is plenty of silver about, but being in the right place, that's what's causing the squeeze on this, and being available now. That's also what's causing the squeeze on this. And there's a funny thing that's happening, particularly, and we stay in contact with the mints and with the refiners. The refiners have focused a lot over this year on processing gold. The demand for gold bars, large format gold bars, particularly those moving east, is huge. So refining capacity has been dedicated to those disproportionately over the last year or so. What that means is that there's a backup in the throughput in the refiners for silver. So they've got a lot of silver there waiting to go through. I spoke to a refiner the other day saying he's got lots of demand for silver products. And we're not just talking about 1,000 ounce bars, the more industrial things like silver grain to go into industry for solar panels and the like. Lots of demand for things like that, but they haven't got the refining capacity to get around to that. So they've actually got warehouses, vaults full of 1,000 ounce silver bars ready to go through, but their refining capacity is choked up at the moment with processing the gold. So there's big delays on that. And that has knock-on impacts all the way down through the supply chain. Because what we deal with at GoldCore, and what a lot of bullion dealers, most bullion dealers deal with, it's the small format products. So it's 1 ounce coins, it's 1 ounce bars, it's kilo silver bars, it's 100 ounce bars. But the refining capacity is reduced as a result of the large demand for large format gold bars. So therefore, those products, so when we're talking about, say, blanks that go to the mints for blanking into coins, there's a supply chain crunch on those. So therefore, what we're seeing is we're seeing lesser and lesser availability in some of these smaller format products as the focus is dedicated to and the refining capacity is dedicated to the large format products. So it's having a squeeze on the retail products. It doesn't suggest, as I said, that there is a shortage, right? And now we have to try to separate some of the narratives in the market. We're talking about a physical shortage of metal. There is metal there ready for refining. There is a very large tightness around refining capacity at the moment, and that has knock-on impacts. Now we're going to step away from the idea when we talk about paper ounces of gold or paper ounces of silver. We're talking about the physical product, getting the physical product through the refining and minting process and through the wholesale process and into the hands of investors. And that's under a lot of pressure at this moment in time.
And I think as well, you just touched on it there. I think it's also really important because when we've talked about this before and we've said, there's no shortage, often people are talking about this kind of paper versus physical situation, but also people also misunderstand when we say that there's no shortage, that they believe we're also saying that there's no supply deficit. And I think it's really clear that when we're talking about there's no shortage of physical bars that are sitting there waiting to be refined into these, let's say, retail demand type products, these smaller products. But long term, obviously, we are looking at the data and we do see that there's this ongoing supply deficit with mining supply, raw materials coming into supply chain. So we're not debating that there's a possible there's a tightness coming further up the chain, possibly. But right now, we're just talking about that silver that is ready to be refined, as it were. When we talk about that shortage, that's what we're talking about.
So the supply demand fundamentals each year are made up of, on one side, the supply, the new stuff that's coming in from the mining and from recycling. And then the demand side is made up of those bits that are, industry that is consumable and those things that aren't consumable, that sit in the vaults. And there is a deficit between these two things and an increasing deficit over the years. And it's going to continue on into the future. But some of that deficit will actually get filled in the future at higher prices. So they say that the solution to higher prices is higher prices. So we've got a large amount of silver. There's no silver shortage in the sense that you walk into vaults and they're empty. There's a lot of physical silver out there, but it is in the hands of investors who are sitting on it. And more investors are moving into that market. So more and more investors are taking that out of the supply chain for use in these consumable products, whether it's solar panels or electrification or whatever it is. So more and more of that is happening. So more and more of it is sitting on the sidelines at a certain stage. And it's the same for everybody that's invested in silver through us. At a certain stage, that will come back into the supply chain. And it comes back in when investors decide to sell. And that's more than likely going to be at higher prices. And if this deficit continues for a long period of time, the silver price is going to continue to rise.
So you just touched on there actually, which is going to be my next question, which is you obviously, in the office with the our great client services team who are talking to clients every day about what's going on. Obviously, huge new interest coming into the market now because
Yeah.
of, I mean, there's just headlines everywhere, particularly about what's happening with the gold price. But we've got a lot of clients who've been with us a long time, and they're probably on the phone as well saying, now what, or what to do, that kind of thing. So when you're saying, we think, people probably like to sell at higher prices, we have been seeing some volatility recently in the last week, particularly, we're talking on Friday, the 24th of October, we have seen a bit of a pullback going on.
Mm.
But the impression I'm getting is that's not coming from retail clients particularly. They still are not of the belief that we have reached, that point just yet where they're ready to take profits particularly. What's the impression you're getting? I mean, I think personally this is just all the prices are just worrying in terms of they just demonstrate what's happening elsewhere in the world. So now is not the time to be selling and taking profits. Is that kind of what clients are talking to you about?
Well, there's different things for different clients. We're at a new all-time high in gold. I mean, they've had a little bit of a correction. We got up to 4,300 odd now. We're a little bit of a correction at this at the moment of recording. We are still seeing a lot of new demand coming in through our trading desks, and the reason being is people are starting to understand what is actually driving the price of gold higher. Effectively, what this is a vote for sound money and a vote against fiat currency. So people are swapping their fiat currency for sound money. They're selling their dollars, their euros, their pound sterling, whatever currency they are, and they're buying gold and silver. Now, I said there's a mix of things that are going on. There are some people for whom gold is actually only coming on the radar. Precious metals are only coming on the radar for them at this moment in time. So it's a new thing to them. Whether it's inflationary pressures, whether it's the fact that they've got money on deposit in the bank that's really earning nothing, it's losing value due to inflation, that they're looking for some sort of inflation hedge, whether it's that uncertainty that's in the world. That is also one of the things that is driving up the gold price. People are starting to really understand how uncertain things are and how uncertain that they're looking. So really what they're looking for at this moment in time is a better form of money. It's a better form of wealth protection, of preservation of purchasing power, which has been eroded over the last number of years. People are starting to understand that a little bit more. So gold is coming onto the radar of a lot of people. Similarly with silver, but silver for a lot of people had been underpinned by a very strong investment case over the years, and that investment case is still there. And if anything, the investment case is actually growing. So we've got a lot of people who are looking at the investment case for silver. They're looking at that deficit and they're deciding to join the investors who are taking silver out of the supply chain and sitting on the sidelines with it until they reach higher prices in the future. That's what's going on in the silver market. But in the silver market, you also have to remember that while gold has been making new all-time highs over the last couple of years, we're only just in the last couple of weeks making a new all-time high in silver. As it broke up through $50. And it was here, there or thereabouts, in 15 years ago, close on 15 years ago. And there are people that would have bought it back then that watched the price go down, went sideways for a bit and then down and stayed down for a long period of time. And they're now getting back up to, on a nominal basis, break even. That's not including the holding cost or the opportunity cost in between the two of them. They're now seeing their silver get back up to the level at which they bought it. So there are some people who thought this would never happen to them, and they're happy to actually cash in their silver because they haven't lost any money on it after holding it for 15 years. So there's different motivations. And the way that I always look at movements in markets is that the price will continue to go higher as long as there are new buyers coming into the market, and new buyers need new motivations. So as more and more people become motivated to find a better form of money for wealth preservation, for protecting their purchasing powers, as they come into the market, the price will continue to go higher. As there are new motivations on the demand side for silver, for example, as new uses are being found, or a wider application, and we talk something like, say, the silver solar panels, as the demand there continues to increase, we're going to see the prices going higher.
So on that, so what are the why are the motivations now? If we just think about, well, actually it applies to both metals, but I'm specifically thinking about silver.
Mm,
What is different about the motivations today than
mm,
was 15 years ago when we had, like you say, it didn't go back to 50 for quite some time.
sure.
What's different today?
But a lot of it is technological driven. Not solely, but a lot of it is technological driven. Silver used in solar panels. We're seeing an increase in the demand for solar panels. We're seeing this move away from fossil fuels. So with that increase in silver panel demand, it's a new demand side fundamental that really wasn't there 15 years ago. And it's not just the solar panels; it's the electrification and the greening of the economies. So whether this is to do with an increase in demand for electric vehicles, whether this is to do with an increase in the technological advancements of using silver solid state batteries, there are a huge amount of new technological reasons for or technological applications for silver. But also what we're seeing as well at the moment is the potential, and there's a lot of talk around at the moment about the reintroduction of silver as an asset for central banks. So we're
Yeah,
seeing,
so this is what I was going to say. There's a sort of politicization of silver. It feels like going on. Are we heading towards that as we've seen with gold
yeah,
in terms of sovereign demand, whether it's central banks, sovereign wealth funds? Yeah, sorry, carry on.
yeah,
Yeah.
no, very, very, very much so. You've hit the nail on the head there. And that's a new demand side fundamental that's coming in. The new motivations for owning and holding silver. So as we see those new demand side fundamental pressures, we're going to see a continued increase in the metal, and ultimately we'll see higher prices.
And I think everyone is watching very carefully with what will happen with the critical minerals list allocation, dimension of silver. Everyone is kind of waiting with bated breath. That could end up having a huge impact on the silver market overall, supply, demand, price, the whole shebang. But I do firmly believe even if that doesn't come to pass, even if silver isn't added to that list, we there is a all of us that spend our time talking about gold and silver need to stop thinking that this is just about what's happening in the West,
Mm,
because already that silver and gold are already playing their own tune over in what's termed the East. There's
mm.
already strategies going on around that. So whilst obviously what happens in the US with the addition to the critical minerals list is key, it's really, really key. I really don't believe that that then takes us back to where we were. That doesn't take us back to square one. This isn't going to be a situation that we saw 15 years ago where we're then waiting a long time for silver to climb back up to 50. I think it's just going to be a feature of silver's story, given what we're seeing elsewhere with demand from the likes of China, India's ETF demand, and so on.
Yeah, and I think what we're kind of touching on here is the speculative aspect versus the investment and reserve aspect. 15 years ago, when we saw the run up in the silver price, it was very much speculative. It wasn't underpinned as much by the fundamentals, but these things aren't happening in a vacuum either. There is there's a change in the monetary system happening, whether we like it or not, at this moment in time. We are seeing a lot of de-dollarization by nations over the last couple of years and continuing. Gold is now a more widely held reserve asset than US Treasury bills are. And that's a new phenomenon. So what we're seeing is we are seeing not just on a individual basis people understanding that the fiat currency in their pocket is not holding the value that it used to, but we're also seeing on a sovereign basis that central banks are moving out of paper-based assets and into physical assets. So this thing's not, it's not happening in a vacuum. And we have to, when we're looking at these things, a lot of the times, people are motivated by the speculative aspect of it. Well, what if I buy it? What if I buy it now and I can sell it in 6 months' time, a year's time, or whatever. It's appreciated by, on average, excluding this year, say 8% since the turn of the century. Um, we a lot of people now are moving away from that kind of speculative idea, and they're looking at their own personal sovereignty, and they're looking at their own portfolios, and they're saying, right, well, if there's a trajectory of where we're going with the monetary system, um, what in my portfolio is actually going to protect me against what that might mean, you
Well, I
know?
think what's quite key is what in my portfolio is actually going to be mine.
Yeah, yes, yes,
Because I
yeah,
think that's so, because so many people, we talk about it all the time. Like, what do you actually own, or what do you own a derivative of? And I think that's the key. That's what people are going to start asking, isn't it? What is mine
yeah,
going forward?
ultimately, yeah. And in terms of the idea of kind of final settlement, what is mine? And the ultimate final settlement is in gold and silver, because it is a tangible asset that I can have in my possession, that is highly liquid, that I can use to exchange into whatever form of fiat currency that I require for whatever exchange that I have. So yeah, ultimately, what is it that is truly mine? And that's why that's why physical precious metals are so beautiful. It's that idea of proximity to your metal, or proximity to your wealth, proximity to anything in your portfolio. The greatest, or the least, sorry, the closest that you can be to your wealth is to have it in your hand, to hold a coin, or a bar, or a piece of your wealth in your hand. That's the closest you'll ever be. The next step away is if you have it stored for you on your behalf. But you can keep on going out of that kind of proximity curve all of the way out. And ultimately, where you end up is you end up in paper-based assets, which are effectively somebody else's liability. There's somebody else's promise to pay. This is final settlement. If it's in your hand, it's final settlement.
And I think as we sort of have more of these sorts of conversations, and going forward, that will end up dominating a lot of our chat, because we've talked about central banks. And I touched on this very recently. Central banks don't decide to invest in a bar of gold on a whim. It's not a speculative thing because it's physical. That takes effort to do it. Last year you and I were at a dinner, and I ended up sitting next to the vault manager of the Bank of England, and he was saying, like, we actually have to lift these bars. We aren't just kind of moving some numbers around. Like, we are lifting these bars. This is a physical commitment.
Yeah.
But that means something. That is something of meaning that is tangible. And I think as you and I keep having these conversations, we will start seeing more investors going, I don't want that distance. I want
Mm,
the proximity. And so when central banks are shipping the bars into their own vaults, or into trusted vaults of other central banks that they trust, that's very key. There'll be less push for these derivatives of around the gold price. And I think that's possibly as well where we start having more conversations. It's not there's a while yet, I believe, until you've got someone phoning up saying, oh, I've been reading about the gold price. Is this something I should be involved in? I think we're probably going to end up having more people going, been investing in ETFs for a while, futures, that kind of thing. But actually, I now want to hold the reason why the gold price is climbing
mm,
effectively. Gold price is climbing because it is a real thing. It's a faceless asset.
mm,
Effectively, it doesn't own and is not owned by anybody. And I think that's how our conversation will develop going further. Because to bring it, full circle to what are the conversations you're having, I can't believe you're having very many conversations yet with people who are still totally green to the gold market. I think there's must be people coming and going, I want the real stuff now.
mm. Uh, yes, yeah, very much, very much. You'd be surprised actually how many people it's only coming on the radar for the first time. So we are kind of having those conversations across the spectrum. As this rally was led very much by central bank sovereign demand, and then below that you start to have the kind of the institutional demand, the high net worth, in the ultra high net worth individuals, mass affluence, and it trickles down, and that ultimately is it's the old Wall Street, JP Morgan story of, sold all his stocks when, the shoe shine boy was talking about them. We're not there. Metal is still incredibly underowned. Whether that's by individuals, I mean, we're probably talking 0.5% globally, right? It's very, very, very underowned.
So what do you
When
think? Sorry, when the likes of Morgan Stanley come out and they go, actually switch up your portfolio allocation 60-20-20 now. What do you think now? Is that just mainly just being heard by, like you say, those institutionals, those ultra high net worths, family offices, that kind of thing? That's still not feeding down to Joe Public,
Yeah,
as it were.
not at all in my opinion, not yet. I mean, but we can't understate the significance of even that Morgan Stanley announcement. So there's two things in that. It's gone from a 60-40 portfolio, the 60% equities, the 40% in bonds, to a 60-20-20, 60% equities, 20% bonds, and 20% in gold. There's two things in that. One, they're introducing precious metals, gold, into their standard portfolio advice going forward. But more significantly, what they're saying is you should be selling half of your bonds to buy it.
Yeah.
So,
Yeah.
so even the large money managers coming out of the US are saying you should move away from paper assets and US Treasury bills as paper assets. You can't understate the significance of that.
Yeah. Yeah. That's the story, isn't it?
Mm.
But I don't even think though that people who are following that and taking that advice are really appreciating saying we no longer trust promises effectively.
Yeah. Yeah. Or we only trust Treasury bills 50% as much as we used to.
Yeah, keep your foot in the water, but not both feet.
Well, I'm quite sure they couldn't have gone 60-40 stocks and gold without having some sort of blowback.
Yeah, quite. And I mean that's the other thing, isn't it? We talk about the politicization of silver. Gold has always been that to some extent. It's always been a statement of this is how we feel about your country, your currency, that sort of thing. And so when the big banks, Morgan Stanley, JP Morgan, etc., are saying get into gold, they are saying there's something over here you can't trust like you used to be able to. It's one thing to say that about certain companies, but to say that about bonds, etc., that is, I mean, that's significant. And I don't think that people are appreciating really what that's signaling.
Yeah, I mean, ultimately, what they're doing as well, at the same time, is they're trying to protect their reputation going forward. So they don't want to be caught on the wrong side of this.
Yeah.
They don't want gold to continue to rally, gold and silver, precious metals across the spectrum, continue to rally over the next couple of years, and then their high net worth individuals are kind of going, "We missed that one,"
Yeah.
you know. My bond portion of my portfolio has been decimated, and you didn't have me in precious metals. So there's a very much protection of reputation going on there. But there's also a lot of talking to one of the money managers there about 2 months ago or so, and they were saying that they needed a look back over a number of years to see the performance of precious metals, and that can be anywhere between 3 and 5 years look back that they'd do, and they would need to see the positive continuous returns over a number of years above a certain level before it will actually come on their radar for inclusion in their portfolio. So we've now getting to that stage where they can look back over the last 5 years and they can see the positive returns. And now, as the metal is continuing even higher, they're now looking to start advising their clients to get into it, which means that over the next couple of years, there's going to be a whole raft of new people coming into this market. And when you squeeze a large amount of people into a finite market, remember, we're talking about all the gold in the world, ever mind fitting into a 20-meter high cube. When you've got all of this new money chasing that physical asset, and the demand for the physical over the paper-based increases, there's only one thing that resolves that equation, and that's higher prices.
It's fascinating. This actually kind of speaks to something just kind of that 3 to 5 year window. That's also how so many democracies in the West run their economies on a 3 to 5 year windows, depending on the election cycle. And as a result, look where their economies, etc., are. They haven't been playing the long game for that long.
Mm.
And yet you look at the countries and the central banks who've been really driving this gold rally for the last 2 to 3 years, they don't run their economies on that
On
sort
such
of
a
this
short
kind
time
of
frame, yeah.
election cycle on such a short time frame. They are playing it to the long game. And we can think about China, who I think in the next month or so are meeting for their next plenum, which is their next 15-year plan,
Mm.
which we'll find out about early next year. That's quite a statement, isn't it? To say, like, when you're talking about the money managers, they go, oh, this will only really come on our radar when it's been doing something consistently for the last 3 to 5 years.
Yeah.
And you and I are sitting here, I've been doing this now 12, 13 years, you ever so slightly longer.
Very polite of you.
And you and I are sitting there kind of with our jaws on the floor going, really, just 3 to 5 years? Because
Yeah.
what about, add a couple of zeros on the end of that, in terms of what it's been doing and what gold's done. And it isn't about gold's performance, it's about the performance of everything else. That's really
Indeed.
what they need to be talking about.
Mm.
And yet the countries who really are kind of creating this sort of dichotomy in the financial system, this polarization, they haven't been looking at gold for the last 3 to 5 years. They've been looking at the performance of everything else over a much longer time.
Mm.
And they know how gold kind of stays steady. And that's why we're now seeing this kind of polarization with the gold and silver markets, with how it's the strategy that's happening, the supply chains, the structure of it all is quite key. And that, just hearing that 3 to 5 years performance really says so much about the psychology of investing here in the West, and how early we are right now still.
Yeah, and I suppose if you think about it, we're talking about things that are long-term assets. They are they effectively, other than land, they are the longest term asset that there is. I mean, humans have been hoarding gold for 5,000 years. Um, when you are set up, and this is no comment on the benefits of democracy over dictatorship, this is just a matter of fact. When you're set up, as you say, in that democratic way, which has massive advantages over a shorter time frame,
Yeah.
you have a shorter horizon on your decision making and everything to ensure that you're re-elected. You really want things to perform within the time frame of that electoral cycle. But if you are China or Russia or India, and you've got a much larger, longer time horizon to consider things over, there you take a different approach. That's just a matter of fact. And we are seeing, we're seeing particularly countries in the East that are driving this, and they do have a tendency to have a much longer time horizon to view these things over, whereas countries in the West have a much shorter time horizon. So therefore, long-term assets and long-term stability is, while it's always the intention, has less attention put on it.
Yeah. But unfortunately, our money managers are treating our investment portfolios as if it was some kind of three to
Similarly,
5 year cycle. And
yeah,
of
or
course, you do
even
need assets
annual.
in your portfolio that perform according to that. But lots of us are kind of thinking for the long term as well.
Indeed.
Um, on that, I think we'll bring it to a close, but I'm going to ask you one last question. If somebody right now, maybe an alien, were to land on Earth and they'd say, why is this lump of rock so prized and digged out of the ground and then put in another hole in the ground, effectively, to quote a famous investor? Why would you say to them that we value, and we value it so greatly, and we consistently return to it as base for our savings and our economies?
That's a big question. I was speaking at an event there back in September, and I started the talk by asking the audience. I said, "Did anybody see what gold did today?" And put up their hands. And well, it went up by X amount of dollars. I did this in dollar terms. It did this in euro terms. It did this. And I said, "No." I said, "Gold did absolutely nothing. Gold is a lump of metal. Wherever it is, it just sat in the corner and it did nothing. It does nothing." And they were very surprised to see and hear a bullion dealer say that. But then I said, that's the beauty of it. That is the beauty of it. You have this thing that has been desired and in demand by human beings since the dawn of time for a number of reasons. Some of those are very basic. It's shiny. It's been attractive. You did a wonderful video a while ago and you talked about the periodic table
Yeah.
and why when it came to money, that there were only ultimately one or two of those elements on that periodic table, gold and silver, that were that were in such abundant quantities and had such characteristics that they could only be the things that could be considered money. It's finite. That's it. So it's finite and it's in demand. It's homogeneous. It's easy to ultimately to authenticate, to break down into small amounts. So it became money for a lot of these reasons, and it held value throughout the decades or throughout the millennia. That is ultimately why it is the most superior form of money. And that's what we want. We want our money to hold value through time. We do not want the money in our pocket, which ultimately is just currency and fiat currency, to lose value when we don't do anything with it. And the only way that we can get it to maintain its value is to give it to somebody else with the promise that they will return it and more at some stage in the future by performing certain duties. Whether that's to do with bonds or equities, it becomes somebody else's liability. So ultimately, you have this thing that is this most superior form of money that is nobody else's liability, that it holds its value through time. It holds the value of your wealth through time. It is protects your purchasing power. What else in your portfolio does that? Nothing. What else is as liquid? So you can invest 100,000, 500,000. You could buy a 3-bedroom house for 500,000. But if you want to realize the value of that, that's months, a lot of expenses, a lot of legal wrangle to actually sell that property. And it's an illiquid market nearly always. Metal, highly liquid, superior form of money. You have to have some of it in your portfolio. And the percentage to which you do that is reflective about your appetite and your perception of the risk that's in the economy. So that can be 5%, it can be 10%, for some people it can be 100%. Go back to Weimar, Germany, when you're seeing hyperinflation. What was the proper allocation to gold at that time? It was 100%. So your perception and your understanding of the risk that is in the economy determines how much of it you should have, but we should all have some of it.
Absolutely. I'm going to leave it there, but that was fantastic. And hopefully you'll come and talk to us again soon. Obviously, everybody's familiar with you anyway, because you do those great interviews with us all, but it's nice to see you on the other side of the table, as it were. Thank you very much. And any more questions for Dave, please send them our way. Take care. Bye-bye.